Hey there, fellow investors. You probably heard that it's not possible to beat the stock market unless you're incredibly lucky, and that index funds are the best thing to invest in. Well, that's not true, or at least not entirely true. In this video, I will teach you exactly which types of stocks that have long-term been seen to beat the stock market. And I'm not gonna tell you that index funds are bad. They're really good and definitely the best choice for most of us. However, I think that you are here because you are much more interested in the stock market than the average Joe and wants to learn more about stocks. And then this is one of the most important things to understand if you want to know how the stock market really works. I'm gonna tell you exactly which types of stocks that have historically outperformed the stock market. And I really want you to understand why. So stick with me through the video and you'll have a better understanding if these are the right stocks for you to own. The level of returns that we get from an investment is dependent on the risk that we're taking. And of course, we're striving for as high returns as possible with as low risk as possible. Then first, we must understand that there are two types of risks here. The type of risk that we can avoid and the types that we cannot avoid. One risk that we can avoid is the risk with individual companies, the idiosyncratic risk, if we want to use a more fancy word. I mean, there's always a risk with an individual company and that this company will fail to deliver even though the stock market in general is soaring. And as you can see here, if we just own a couple of stocks, we're taking a huge risk here. But if we have enough stocks in our portfolio, we can reduce and effectively eliminate this risk. And in principle, when we get to around 10 to 20 stocks, we have effectively reduced this risk almost as much as possible without us having to own thousands of stocks. Because you're not gonna reduce this risk much more from this level. This means that just because you're taking the risk of owning just a few stocks in your portfolio, this doesn't mean that you can expect higher returns, as the risk associated with this is avoidable. And then we have the risks that we cannot avoid. This is if we want to invest in stocks, of course, the systematic risks. And then, or if we take these kinds of risks, we expect to be compensated in the form of higher returns for taking the risks in the first place. I mean, when you buy shares instead of placing your money in a savings account, most of us know, and I really do hope that all of you watching this know, that we are taking a higher risk. But for this risk, we also expect to get higher returns and to see our money grow faster and more than they would have done in the savings account. This is something we cannot avoid if we want to invest in stocks. It comes with a risk. We can't avoid it, and therefore this is a risk that we can expect to get compensated for with higher returns. When we buy shares, in principle, we're buying the right to get part of future profits of the company. But the company profits are not guaranteed, of course. We expect that the company is going to make the profits, but there's no 100% guarantee that they will. And because of this, we can get a certain discount when we buy the shares. If we take the two companies A and B as an example, let's assume that we think that company A will make a certain profit with 80% probability, while company B will make this profit with 90% probability. Yeah, well, then we're not going to want to pay as much for shares from company A than from company B, as with A, we're taking a higher risk. And at the same time, if we would have bought shares from company A and the price of these then rise, as the company managed to make the profit we expected, then we got higher returns as we bought the shares of company A at a lower price. So by taking on a higher systematic risk, we expect to get higher returns. Maybe you've heard that we're talking about something called alpha and beta when it comes to stocks and investing. There's even a famous website called Seeking Alpha that you probably all visited. So to find alpha means to find a stock that gives a higher expected return without taking on a higher risk. Alpha is a kind of excess return and beta is the risk. So if we have found two stocks with the same risk, but where one have performed better than the other, then we have found alpha. In our example with company A and B, this could be that if both companies say had 90% probability of reaching the profits we anticipated and we bought shares from these both companies at the same price, then they both reached the goals and then the price of one of these shares rose more than the other and we got a higher return from this. Then we had taken on the same level of risk, but for some reason one got excess returns from what we expected. And this is exactly what active portfolio managers are trying to achieve. By picking the right stocks and time the market, they're trying to produce higher risk-adjusted returns than the stock market as a whole. and the beta is the risk. And in the original model used to explain the returns of stocks or portfolios called the capital asset pricing model, or CAPM, that was suggested in the 1960s, the general market risk was the only risk factored in. This means that if two portfolios had the same beta, meaning the same risk, but one of the portfolios produced higher returns, it looked like the higher returns was dependent on the superior stock picking skills of the portfolio manager. The better performing portfolio had a higher alpha, and the portfolio manager was seen as more skilled. Through the CAPM model, where there is only included the alpha and the general risk of the stock market as the beta, around 65% of the difference in returns between two portfolios could be explained and attributed to differences in the level of risk. I mean, if two portfolios with different returns was compared, then 65% of the difference could be attributed to the different levels of risk, and the rest was attributed to the alpha or the superior skills of whomever composed the portfolio. But then gradually, different types of stocks were found that seemed to consistently produce excess returns compared to what could be expected if there only was one type of risk, the risk of the general stock market. And if any type of stock consistently produces high returns without simultaneously exposing it to a high risk, then the markets must systematically somehow misprice these type of stocks over and over again. Or maybe there were other types of risk that the CAPM model didn't take into account. And it's pretty easy to imagine, I think at least, that there is not only one risk or risk factor that can affect the stock market. I mean, after all, there are a whole range of macroeconomic indicators that affect the stock market, such as where we are in the business cycle, where the interest rates are, and how the inflation is at the moment, just to take a few examples. One can also imagine that different types of companies could be affected differently by these macroeconomic factors, and thus it's not that far-fetched that different companies would be affected by and exposed to several different risk factors. I mean, company A might be more dependent on where the interest rates are, while company B is more affected by higher inflation rate, for example. The risk with buying shares of company A then would not be the same as buying shares from company B, right? And in this way, one can think of these different companies types as sort of an approximation for these risks that are harder to measure in themselves. There are several models that have been used to explain this, and the most well-known are probably the models from Eugene Fama and Kenneth French. In the middle of the 1990s, Fama and French proposed a 3-factor model, and in 2015 they extended this to become a 5-factor model, or simply they identified 5 different types of risks. Remember that if we take on more risk, we expect a higher return. The first 2 extra risks that was added with this model, in addition to the general market risk, was a special risk for small companies and 1 risk for value companies. This means companies that for some reason have a lower valuation. There is no risk in itself to be a small company, for example, but a smaller company might be more affected by these underlying changes to the economy. And then we can use the smaller companies as an approximation for this underlying risk of changes to the economy that is harder to measure in itself. This means that with smaller companies and value companies, there are additional risks, and if we expose ourselves to these additional risks, we expect to get higher returns. And there's someone who intuitively understood this long before the researchers Fama and French did. And this is of course the well-famous value investor Warren Buffett. So the size of the company you can simply find by looking at the market cap. And to understand if the company is a value company or not, you should take a look at the book to market value. If the book value is higher compared to the market cap, then the company is more undervalued. And I will show you exactly how much these 2 company types have outperformed the stock market in general, but first let's take a look at the other 2 factors that was added on by Fama and French in the 5-factor model in 2015. The profitability and investments were also added in. The company's profitability can be measured by looking at the gross profits to assets, and of course it should be better to own companies that are more profitable. And then we want to have a higher gross profit to the assets. And how much a company invests can be seen by looking at the growth of the book value from one year to the next. So companies that are investing more aggressively tend to actually produce lower returns. Using the Fama French 5-factor model, closer to 95% of the difference in returns between diversified portfolios can be explained. Remember that with the original CAPM model, when we only accounted for the general market risk, we could only explain 65%, and the rest was attributed to the skills of the portfolio manager. This also means that a lot of portfolio managers that were previously seen as especially skilled or had found alpha when it comes to picking stocks and time in the market really just managed to produce high returns because they were taking on additional risk. And this is why their portfolios were excelling. Now maybe 2% doesn't sound that much to you, but after 10 years with 2% extra annual returns, you would have accumulated 20% more. And after 20 years, you would have had 44% extra, and after 30 years, nearly 75% higher total returns. A pretty significant difference if you ask me, and if you're investing long term, for retirement for example. And this is because of compound interest. Now, what's important to understand here is that these factors are not completely independent of each other. Especially the value, profitability, and investments are more connected with the risk of defeating the purpose if you only take one of these into account, without looking at the other factors too. If we only look at the profitability, for example, disregarding the value, then we would probably only find growth companies, and then we would have a negative exposure to the value factor. So it's important to look at all of these factors together. And the size factor, I mean that smaller companies beat larger ones, even if we see this effect in the data in different markets and during different time periods. When performing statistical analysis on these factors, this doesn't hold, and it comes out as non-statistically significant. Yeah, it's a bit hard to understand. This means that if we just focus on small companies without taking any of the other factors into account, you cannot expect to get higher returns. But what we do know is that this effect of the other factors come out stronger in smaller companies. So to focus on small companies together with a low valuation and a high profitability, for example, could be a winning strategy. And we cannot expect to always get higher returns if we invest in any of these company types either. Just as we can't expect the stock market as a whole to always go up. And it's taking decades historically for the stock market to reach a new all-time high after a crash, or long time periods where the stock markets trailed the returns from a savings account or treasury bills. And in the same way, it's taken 10 years or more where one of these or more of these factors or different types of stocks have trailed the general market. And you might have heard that value stocks in the US have trailed the general stock market and growth stocks during the last decade, despite this model saying that they should instead outperform. And they have outperformed long term and still are in other markets. And when one of these factors are trailing the market, another usually is producing higher returns. This is also why you should not focus solely on one of these. What I think you should take home from this video is that there are different types of risk associated with stocks, and this is good to understand nonetheless so that you know which risk you're taking with your money. It can also be a good idea to hedge yourself to these risks so that you're not exposing yourself only to one of them and buying stocks from only one of these company types, as we saw that they can trail the market during different time periods. And then you can make the decision whether you want to take this higher risk exposure and expose yourself to these factors and maybe get higher returns or not. Did you use any of these factors to get higher returns, consciously or unconsciously? Maybe you're more drawn to small companies, or you like dividend stocks where you reasonably would expose yourself to the risk associated with more conservative investors. I could continue to talk about this subject for much longer, but I think we'll end the video here before it gets way too long. So I'll see you again next time.